On this episode, we're going to talk about some basic terms used in property investing. Hey guys, and welcome to another episode of Property Investing Plus. My name's Josh Redman, and I am here because I want to inspire and help you use the money that you have more effectively. So we are still really excited. Things are still happening here at Property Investing Plus. But look guys, if you've got a question for the show, you want to get your question on this show, just use the hashtag Property Investing Plus on Instagram or Twitter. But let's get straight into it. So today I thought it'd be really good just to cover some really basic terms that are used, because I know sometimes you can hear some things and not quite understand them. So to avoid using jargon and getting lost in jargon and failing to communicate properly, I thought, well, why not? We'll make an early episode about some of the basic property investing terms. First term today is appraisals. Now there's two different types. There's a rental appraisal and an appraisal which is a valuation done by a professional valuer. Basically the rental appraisal is where you have a real estate, estimate the value of the rent that you'll get each week, and an evaluation is done by a professional valuer who basically gives you the value of the property. Appreciation, now that simply means an increase in value. Basic variable, now this has to do with a home loan that has a lower rate but generally less features than a standard variable home loan. Break costs, now these are the fees that are incurred when a home loan's paid off ahead of time. Body corporate, now this is an administrative body that's made up of the owners of units or apartments of a strata building. Now the owners elect the committee, and they're basically in charge of the upkeep and the admin of the site. It also can be referred to sometimes as an owner's corporation. Another term you might hear is bridging finance, and this is just a loan to cover a gap or a period of time. It's a short-term loan basically used in between buying a new property and selling an existing one. Capital gain. Now this simply is the increase in value of your property over time since the purchase, so it's from the purchase price. So let's say you bought a property for $300,000, it's now worth $450,000. That means you've had capital gain of $150,000. So it's just simply the difference between the current value and what you paid for it originally. Cash rate. Now the cash rate is the rate at which the Reserve Bank of Australia sets the interest rates. Another term associated with that is bank rate, and basically bank rate is what the banks decide on their interest rates, which will always be a little bit more than the cash rates to allow for a bit of profit. Next term is cash flow positive. Now this is a positively geared property. So it's basically where all of your incomings are greater than your outgoings. So you are making more money than you're putting into the property. So let's say that your rent is more than your mortgage repayments and other expenses associated with the property, like maintenance, rates, all that kind of stuff. So that is a cash flow positive property. CGT, or commonly known as capital gains tax, is the tax that you pay when you sell an investment property for a profit. Now don't be afraid of paying tax. Conveyancing. Now this is the process involved when you legally transfer property from one entity to another. Cooling off period. Now this is a term used to describe the period in which it's okay for a buyer or a purchaser to pull out of buying a property. Now it varies from state to state or wherever you are, so it'd be important to look into that. Another term you might hear, but I hope not, is default, and this is just failure to pay a debt at a due date. Another term you might hear is density, and this has to do more so with the amount of people who are allowed to live within a certain area, or how dense it can be or full of people it can be. So the level of occupancy in a given area. Another term you want to get familiar with is depreciation. Now this is just simply the decrease in value of an item over time. So this can be something like the fittings and fixtures in your house, or even the house itself. Another term you really want to get familiar with is equity. Now this basically is the difference between the value of a property and the mortgage that you have against the property. So let's say you had a house that was worth $400,000 and you had a mortgage against it which was $200,000. Your equity then is the difference, which is that remaining $200,000. Now another term is fixed rates, and this is where a interest rate for a home loan is fixed and it will only be for a certain period of time. Another term you'll have to get familiar with is interest only. Now this is a version of a home loan where you're only paying the interest that's incurred on the amount owing. So you're not paying any of the amount owing, you're literally just paying the interest that's incurred. Another term you'll hear or see will be LMI, and this is lender's mortgage insurance. Now this is usually a requirement by lenders when you're borrowing more than 80% of the property's value. It basically just provides insurance for the lender, the bank, just in case there's a default on the loan itself. Another term you'll hear is LVR ratio, or loan to value. So basically what you do is you take the loan amount, you divide it by the value of the property and times it by 100, and you'll end up with a nice little percentage which will be the LVR. Now banks and financial institutions basically use the LVR ratio to work out whether you can afford a loan. Another term you would have heard if you've been watching is negatively geared. So basically this is where your incomings are less than your outgoings. So a great example would be you're receiving $600 a month rent, whereas your mortgage repayments are $800 a month, and that creates a shortfall of $200 each month, which creates a negatively geared property. Another term you'll really need to get familiar with is off the plan. And this is when you purchase a property that hasn't been built yet. So it's under construction or will be soon as the sale is finalized. So you're purchasing something by only looking at the plans, hence the term off the plan. Now this is very common in investment property purchases. So just be aware of that and definitely become familiar with that term off the plan. Another term is passed in, and this happens at an auction when the highest bid hasn't met the reserve price set for that particular property. So in effect, the property won't sell at the auction. Another term you'll hear is portfolio, as in property portfolio. So this is basically the number and the type of property, investment properties that you own. Another term I'm really fond of is positively geared, and this basically means that the income you receive from this particular property is more than the expenses associated with that property. So a great example of that would be you're receiving $1,000 a month from your tenant, but your expenses associated with that property are only $750, so it creates $250 each month in your pocket. All right, another term is principal and interest, or commonly referred to as P&I. Now this is the amount borrowed or still to be repaid, which is referred to as the principal, and the actual interest on that amount that's still owing. So the principal, if paid down, basically reduces the balance of the entire mortgage. Another term you might hear is property cycle. Now this just refers to at what stage the property cycle is at. The three stages of the property cycle are basically prices are going up, prices are going down, prices are staying the same. Another term you'll need to know is refinance, and this is just getting new finance for something with different terms. So basically it would involve paying out an existing loan and opening a new loan. So another term you'll have to know is rental yield, and this basically is the percentage return that you're getting on your overall investment. So basically to calculate your gross rental yield, what you need to do is take your weekly rental amount, times that by 52, and then divide that into the overall price of the property. So basically once you've got that, times that by 100, and you'll end up with a nice pretty percentage to know exactly what you're getting back as your rental yield. Another term you might hear is serviceability, and this basically is all about whether you can manage your mortgage repayments based on things like income and expenses. Another term is stamp duty, and this is a state government tax on the transfer of property calculated using the total value of the property. Another term you'll hear will be subdivision, and this is where a larger lot is basically split into smaller lots. Another term you might hear is supply and demand, and this is all about the supply of property and the demand of property and where they meet or intersect. And that point where they intersect is called the equilibrium. So a market is at equilibrium. So you'll hear things like there's an oversupply of property, which means that there's lots of houses on the market and no one's buying. Or there's high demand and not enough supply, which would mean that there is demand for housing, but there's not enough being built or supplied to reach that demand. Another term you need to get familiar with will be vacancy rates. And this is all about rental properties and how available they are. A low vacancy rate means that there's not many properties available to rent. A high vacancy rate means that there is an oversupply of rental properties for people. So what you essentially want as an investor is a low vacancy rate. Alright guys, that's it for this episode. I hope you enjoyed it. I just wanted to make sure that we all were on the same page and we all understood a lot of the jargon that's used in the property investment market. So listen, if you enjoyed it or you've got something to ask, you can leave a comment down below. But don't forget to subscribe to my channel. I'll be releasing a new video every week. So I look forward to seeing you in the next one. Thanks guys. See you later.